So my point is, a loan can be used as leverage in conjunction with another vehicle to help create a debt tool for you. Because your checking account can also be used as a debt tool, but it would be used as a debt tool in conjunction with something else. But let's kind of dig into or talk a little bit more about a debt tool. There are many different types of debt tool, and there's really no wrong answer. For me, if I'm looking at a debt tool, the type of debt tool that I'm looking to be able to leverage and or use is one that is open-ended. Meaning, not only can I put money in it, I can get money out of it. Well, there are some debt tools that we may be forced in a position to use may not be open-ended. And that's okay. So let's kind of talk through it. So there are credit cards that a lot of people use as debt tools. There's personal lines of credit. There's home equity lines of credit. Now, I put here a self-directed 401k loan. In truth, a debt tool is just leverage. So can you use a loan, any loan, as an open-ended vehicle? No, you can't. For a loan, in most cases, you can use that dollar amount, leverage that dollar amount, but it's not a dollar amount that you can put money onto it and get money out of it. Usually it's one directional, meaning you can make payments on it and you can use that loan, but it's a one-time use, right? It's not something that you can use multiple times or go back and forth, putting income onto it and taking income off. So what I'm saying here is this can be used as leverage. And if you're going to use it as leverage, you're going to use it in conjunction with a checking account or use it in conjunction with a line of credit. So all I'm saying here is it can be used as leverage. You can also put here a consolidation loan. Consolidation loans can be used as leverage. So my point is a loan can be used as leverage in conjunction with another vehicle to help create a debt tool for you, because your checking account can also be used as a debt tool, but it would be used as a debt tool in conjunction with something else. For instance, when I started Velocity Banking, I couldn't qualify for a line of credit like a personal line of credit or a home equity line of credit. I couldn't. So what we ended up doing was borrowing from my self-directed 401k and using that to chunk away at a debt. And then I connected a credit card as overdraft protection to my checking account. So my checking account in conjunction with this credit card is what truly made my debt tool. And then ultimately, you can also use a business line of credit as well. So my point is there are many different types, and there's really no wrong answer as to which one you use. It's just some are more flexible than others. And understanding how you use those debt tools and what those debt tools are capable of, what's the impact on using them. For instance, when we started doing Velocity Banking, again, I was using a checking account and I was using a credit card as overdraft protection. Well, I was getting charged a fee for that overdraft protection. And that fee was, I had to weigh the math around. Do I take the fee, the charge for the overdraft protection and continue to do Velocity Banking? Is it worth it? Am I saving money and interest that I'm spending by paying off this debt faster while also getting hit by a charge using this overdraft protection? I had to weigh that out. And so my point is, you may have to do the same. Some of these are great by themselves, but some of them have to be used in conjunction with other vehicles, meaning these two might have to work together, or these two might have to work together. But that's where you kind of have to think this through. But the bottom line is a debt tool can be many different things.
Does the type or structure of the debt tool matter? Just found that one of my HELOC is a second HELOC and not simple interest. The interest is amortized.
So if the interest is amortized, it sounds like it might be a loan.
Like a second mortgage, right?
Sounds like it might be a HE loan, which is not unusual. And a lot of times it's not unusual to have a home equity line of credit that is not simple interest. It may be, meaning it's not, what do you call it? Not simple interest. It may be variable, meaning the interest may increase over time. But if you're saying that the interest is amortized, that sounds more like a loan to me. But still, let's say that's the case. Then what you may have is you may have a loan that you may need to leverage in addition to your checking account to be able to do Velocity Banking effectively. Meaning you still may be able to do Velocity Banking. It's just that now that you know how this vehicle is actually working, there are some limitations to how you're able to use that vehicle. Meaning if it's an amortized loan, you may not be able to get income into it. You may be able to get a dollar amount out of it and leverage that dollar amount, but you may not be able to truly use it in the fashion that we would traditionally use a debt tool for. Again, maybe what we could do is jump on a call and we can talk a little bit more about how that debt tool that you're using is working for you, because maybe there's an opportunity to use it in conjunction with something else, or we use this as a setup, as a foundation to put yourself in a position to go after a vehicle that you can adequately use. And here's why I say this. In just doing the research around today's live, there are a lot of banks that are offering personal lines of credit again. They had stopped, I say right around that COVID period, they had stopped offering personal lines of credit, but I'm seeing a lot more banks. Specifically, I spent a lot of time this weekend looking at US Bank. US Bank has a really nice personal line of credit option that is, I think the best interest rate on a personal line of credit for them, you need like an 800 credit score. But I think anywhere between I'll call it 660 to 800, there's a pretty decent product out there. So again, maybe it's, yes, I'm going to leverage this loan in the short term to be able to get myself in a more positive credit worthy position so that I can qualify for a vehicle that makes more. Purely made up, but I just want to kind of walk through what that math looks like on the surface. Meaning, if you make $4,000 a year, that income traditionally would go into your checking account. Again, the idea is we identify some type of line of credit where we can put all, not some, not a portion, all of our income onto that debt tool. And once we do, again, it's going to satisfy the payment on that debt tool, and then we pay bills from there. And those bills may be a series of different expenses that we might have, right? And in this case, we put in 4,000, maybe we've got expenses of about 2,500. So what's left? What's left is about $1,500. Where does that $1,500 live? It is not living here. When we put all of our income onto this debt tool and we pay bills from it, that cash flow now sits on this line of credit, which reduces the overall balance and reduces the amount of interest owed. But let's dig a little bit deeper into what's actually happening inside of this line of credit. What does that look like? Well, in this case, what we're using here is a line of credit. You can call it a personal line of credit if you want, with a $20,000 limit. That $20,000 limit has a $15,000 balance on it. So the limit is $20,000. We got a $15,000 balance on it, meaning there's $5,000 of room. And this line of credit, usually I move very fast through this process and we talk very little about the impact of the interest. So let's kind of dig into some of that. And the interest rate on this line of credit is 11.85. Well, using this process that we just discussed, so if you've got this line of credit and we're putting $4,000 onto the line of credit and that cash flow of $1,500 is living on that line of credit month after month, well, what's happening is if we just were to look at month one, when that $1,500, and I think I'm saying 15,000, when that $1,500 in cash flow hits that line of credit, it's going to reduce this balance. So if we look at the first 3 months, or first 4 months rather, that's $4,500 that this balance would end up being reduced. If we started out at month 0 with a $15,000 balance and we had $4,500 of cash flow sitting on that line of credit, we now have a new balance of $10,500. Okay, that's $10,500 balance with a limit of $20,000. Well, what if that car note that we were paying, we decided to now chunk away at that line of credit, meaning we've got a car sitting here that we've been paying $450 a month on at 5.25%, and the balance on that line of credit, the balance on that car loan is about $6,500. It's interesting. When we were walking through this example, my wife and I, she made the comment, but wait a minute, the line of credit on this, the interest rate on this line of credit is 11.85%. Why would I take a line of credit at 11.85% to pay off a car note, to pay off a car loan of 5.25? Like, that doesn't make any sense. I'm using a larger interest rate to pay off a smaller interest rate. I think this is the conversation that a lot of couples end up running into. And this is where you have to peel back a few layers and do the math. Because in essence, I've been paying $450 a month for a long time at 5.25%. Let's look at that. But in addition, if I was to all of a sudden take $6,500 out of this line of credit and pay this car off, what happens in that instant? The instance I pay off this $6,500, that payment of $450 a month is no longer required. And when that payment of $450 a month is no longer required, my cash flow goes from $1,500 up to $1,950. So what? Well, when my cash flow increases, again, thinking of it from the perspective of Pac-Man, when my cash flow increases, when I eat one of those power pellets, what am I able to do? I'm able to crush more debt faster because my cash flow has just increased by $450.